Welcome to Smarter Markets, a free weekly podcast featuring stories from the entrepreneurs and icons of commodities, capital markets, and technology, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we explore the questions: is capitalism in crisis? And will building smarter markets be the antidote?
Welcome to Smarter Markets, a weekly podcast that explores how financial and technology markets can be redesigned and improved to better serve market participants and society as a whole. Smarter Markets is brought to you by Abaxx Technologies, and I'm Todd Buchholz. You can follow me at EconTodd or econtodd.com. Over the coming weeks, we will continue to examine the crisis of capitalism and whether or not smarter markets is the antidote to a more inclusive and sustainable future. My guest on this week's episode is none other than Josh Crumb, founder and CEO of Abaxx Technologies and Abaxx Exchange. Josh is on a mission to re-examine our global market and technology systems so we are able to achieve the 2030 Paris Agreement objectives ahead of schedule and be halfway to carbon neutrality with a fully developed path to neutrality by 2029. ESG, or Environment, Social, and Governance, presents quite possibly the single greatest market opportunity since cloud computing, with sustainability funds on Wall Street already approaching $2 trillion. Today is the first time Josh has been interviewed on Smarter Markets, and I'm delighted to bring him into the conversation we started with Stefan Wieler and Arjun Murthy over the last couple of weeks. Josh and I will be boldly crossing the bridge to renewable energy and an accelerated carbon-neutral future next.
And now, back to this week's episode of Smarter Markets.
We're coming off two fantastic energy transition discussions in the past 2 weeks with Stefan Wieler and Arjun Murthy. And Josh Crumb, you're not only the third part of this series, you're also one of the co-founders of this podcast. You're responsible for all the intelligence and all the blather that's gone on in the last couple of weeks. And let's face it, this is the most fascinating time for commodities, for ESG, perhaps in our lifetimes. Just recently, we see in the commodity pits that iron ore, timber, palladium have hit all-time highs. At the same time, the entire world is wondering, are we ever going to run out of these sorts of commodities? Can we mine and develop such commodities without spoiling the planet? So we've got some awfully important issues to put on the table. But I'd like to ask you before we get started, why is it that you got interested in creating such a podcast at this moment in time?
So maybe the best way to start to talk about the podcast is maybe give a little brief background of my own background. I am a mining engineer originally, but I'm also have done graduate work in both economics as well as political risk and the international political economy. And so ultimately, I guess I'm sort of a systems guy. I like to see how many different pieces work together. When you're in the natural resources space, when you're developing a project, you have, just unbelievable amounts of geologic and technical risk, as well as economic risk and of course, political risk. And so when I think about the podcast and really some of the very big energy transition themes that we'll be talking about through this episode and beyond, these are some very, very big, multifaceted challenges that I think it requires, systems thinking across many different disciplines. Ultimately, if we're looking at the goals of creating, carbon neutrality globally over the next 20, 30 years, this is essentially one of the biggest engineering projects of all human history. If you think about where we're at now, with probably about 80% of our global energy needs coming from hydrocarbons, and maybe even stepping back a little bit further. I mean, a lot of the academic research, right to the levels of like kind of what makes us human is our ability to harness external energy for our food sources and communications. And so we're really, as a species, trying to, basically change our entire, way of burning things and change, the entire global economy at the same time. So these are enormous engineering challenges. They're enormous political challenges. But at this point, I think this is something that the world's setting out to do. So the point of this podcast is, I guess, as an engineer, I probably try to minimize my public speaking, and as an economist, I think people try to minimize listening to economists like us speak. so I think for me, it's been throughout the pieces of my career, I've been very fortunate to work with people like Jeff Curry and the Lundin Group and Robert Friedland. And so, having access to these types of networks, I wanted to make sure that, some of the smartest, some of the biggest thinkers in the world are given the platform to have these really hard conversations. So that's really the background of the podcast and what we're trying to do. It's not just the energy transition, but also a lot of the technological, the software and internet systems that are constantly changing and evolving that will have to be part of, that have a huge role to play in this energy transition, and talking about things like digital identity and privacy. So there's all sorts of pieces to this. What we've been trying to do is build these little mini series, trying to tackle all of the little, not little, but tackle some very big ideas and very big things in little pieces, so that over time, these voices, we can start putting these pieces together. So that's really, I guess, my background as a multi-system, sort of thinker, and trying to put together a podcast similarly.
Clearly, you want to be on the cutting edge of all sorts of things, and hopefully we won't be slitting our wrists in the meantime with that edge. But Josh, for those of us who haven't gotten a chance to know you, I think it would be interesting to find out, where did you grow up and where are you speaking to us from today?
Well, I grew up in Colorado, so originally from Greeley, Colorado. So I'm a little secret I'm now telling the entire world as a mining person. I actually come from the flatlands of Colorado. So one of my mining engineering colleagues early on said that I always pretended to be a mountain man, but I'm really a pig farmer. And then I went to the Colorado School of Mines. And after that, I really have been involved in the resource industry from lots of different angles for really the last 20 years. So started out in engineering design and project management, worked out at a gold mine. I traveled and lived in Russia for a while, and eventually got into the corporate side of mining with the Lundin Group, and working in M&A and project valuation sort of all over the world. And then I, just after the financial crisis, I moved over to Goldman Sachs, where I was the head of metals research and strategy under Jeff Curry. So the last couple episodes that we've had were actually some of my former colleagues. So I was on the metals side of Jeff's team when Stefan was the head of oil research, and then Arjun Murray was leading the equity research at that time. So really, these are two individuals that I just highly respect, and I think there's really nothing I can add to the conversation of the big energy companies or the macro economy as far as energy. But what I would try to add is some of the market structure and some of the software systems that are going to be needed during this energy transition. So happy to talk about some of those things as well.
Josh, just going back a little bit, it wasn't too many years ago when peak oil was a common term. And now if you do a search on Google of the usage of that phrase peak oil, it doesn't crop up much anymore. I'm just curious, as someone trained as an engineer who's also trained in economics, what were you thinking those not many years ago when so many purportedly brilliant people were telling us that the world was running out of energy?
Yeah, I mean, it's a great question. And I think, again, it's another kind of part of this podcast is have these types of conversations, because I will readily admit, back in the 2006, 2007 days, in fact, one of the reasons I ended up at Goldman Sachs is I was kind of predicted the global financial crisis, as well as the shooting up to $150 oil. So I had built a lot of models that predicted that, and I was very, very bearish of the global economy and the global financial system because of that. And I guess when some of my predictions played out, that's actually how I got to know Jeff Curry and ended up working over at Goldman. So I probably came from that little bit more conservative economic thinking. We're running out of oil. But I think, it's something that really changed in my worldview over the last 10 years, and really it was really in 2011, 2012, is the shale oil revolution, and looking at, kind of always being skeptical about the growth rates of shale, and maybe other, skeptical and, sort of broader technology senses as well. And I think that over the last, 10 years, I think I've come to think that there's actually a lot more hope, than these, I guess, sort of constantly at the end of every commodity cycle, thinking about, the limits to growth. And so, Jeff Curry had a great line. He always said, give an engineer enough time and enough money, and you can solve anything. This is a very, very big, when we're talking about decarbonization, this is a very big problem that's going to need a lot of money. And and if we want to meet the goals, not a lot of time. But ultimately, I am hopeful. And that's sort of, some of the things I want to talk through on this episode.
It does seem to me that it's easy to forget how markets act. There's that saying that the Stone Age didn't end because we ran out of stones or ran out of rocks. It was because we found alternatives that were more efficient. In the same way, when prices go up for a particular commodity, it creates incentives to discover and develop more, or to discover and develop substitutes, which makes this ever more complex as we get into it. Now, I wanted to get into some comments I've heard you make regarding 2029. That not only could we achieve the Paris climate goals of 2030 and 2050, but that we could make it a mission to wrap it all up in 8 years? Now, engineers are supposed to be pretty practical guys. Have you left that all behind? How is this possible?
No, absolutely. And I think, coming back to that hope and vision, I think, that my sort of, the call for the 29ers, what that's all about is, of course, looking back at JFK's moonshot speech, which he actually gave in 1962, and talking about, putting, this great human, global sort of engineering problem of putting a man on the moon. And it was, it was before the end of the decade. It was very specifically, we're going to do this by 1969. So when I look at what's happened in the global economy over the last year or two, and really what's happening in upstream industry, that I'm kind of, the acceleration and the conversations about decarbonization that we're having really by the week to sort of, organize ourselves on a global level. I think the very specific thing that I want to point out about, my view and my mission of the 29ers is this needs to be done by markets. You mentioned the point about, sort of to paraphrase, nothing solves a high price like a high price, but we need that price signal. We need to price the externalities. We need to price the goals that we're trying to achieve. And in that way, I think the market can do all sorts of good things. And so, one of the other pieces of that, and going back to the JFK's speech, was that, this is global. Even though this was in the middle of a, very fierce, Cold War space race, it was very specifically mentioned that this is a global challenge and a global mission that we all need to be cooperating in. And I think that's a big part of it as well, is this is, in my view, we're at a time where, on both sides, we've gotten so political in so many ways. And when I look at the resource industry and look at the goals of the Paris Accords, you're looking at, part of it is saying, this is absolutely impossible. We can never do this. This is sort of almost the peak oil, type thinking. But then on the other side, I guess, if you get to the more extreme sides of the left, they don't even want to talk about carbon neutral. They want to just stop growth altogether. And so really, we're in this really challenging political environment where the call is, look, this is happening. If we look at, particularly if you look at the announcements that China made late last year about their goals for 2060, if we were taught anything in global markets the last 10, 15 years, is when China says they want to do something, they essentially, they mobilize their economy to do it. And so if you look at China being about a third of the world's global emissions, and of those emissions, probably 40% of that is upstream commodities and early pieces of the supply chain. When they say that they're going to decarbonize or go to net zero, this is something that, any holdout is really going to get overrun at this point. The global economy, the incentives of the market are going to move this direction. And so I believe this is one of the greatest investment opportunities, really, just like it's one of the greatest engineering opportunities, it's one of the greatest investment opportunities of all time. And so we really need to get on with the thinking of, okay, this sounds really, really hard, but that's why we should do it. And that's where the phenomenal wealth is going to get created, is to just, let's take the next 8 years and let's get building. So that's really the mentality that I wanted to express with the call to the 29ers.
Josh, you make an excellent point about how things can become so politicized. I remember around the time of the financial meltdown, I was deeply involved in the markets. I also, at the time, was a fellow at Cambridge University. And I went to a meeting with faculty, and we were talking about sustainability. And I realized, and this reminded me, by the way, of Winston Churchill's purported saying that the U.S. and Britain are one people separated only by a common language. What I realized in going to Cambridge was that there was a difference in the language. When most Americans would speak of sustainability and sustainable growth, they were talking about growing without despoiling the planet. But among intellectuals in the UK and in Europe, it was not a matter of growing without creating pollution or climate change. It was a matter of stop the growth. Do not pursue a higher per capita GDP. And these issues become very thorny. And I praise your optimism in thinking, and I agree with your optimism, that we can create greater growth, a higher standard of living, but do so in sustainable ways, in which case the planet and long-term life is better off. After all, if you look at the environmental conditions in poor countries compared to wealthy countries, wealthier countries have less pollution because we can afford to invest more in technologies that reduce it. You look at the Soviet Union when it existed, it was far behind the U.S. in wealth, in GDP per capita, in standard of living, in all sorts of ways. And it was fetid and polluted, and the water could not be drunk and the air could not be breathed. So I think the point you make that there are ways, I don't know how to design them, but markets will develop and evolve in order to capture productivity improvements and create a higher standard of living without necessarily making it more difficult to breathe and to eat and expect the planet to survive.
Absolutely. And really it comes down to, again, it's pricing these externalities. So we know there's going to be a lot of costs, just as the urbanization of China really in, the earlier part of this millennium, create a lot of changes globally, and the costs and benefits weren't always, very well thought out in advance. And so really this next investment cycle. So if I look at the first sort of 10 years of millennium and I look at the BRICS themes, which was really driven by Chinese urbanization, but also other emerging markets, globally. This was a very resource intensive time, and there was a lot of disruption to the particularly the middle class of the OECD countries. And then we had this next sort of decade of investment, really around the rise of cloud and mobile, and really connecting this global middle class to the internet through handheld phones. So these were two incredible investment trends the last 20 years, but they also created a lot of social externalities, both environmental and social externalities. So really, building on both of those themes the next decade, because we do have a connected global planet, this is where we really want to think about the IT and the infrastructure and the communication systems to achieve these goals. Now that we do have a globally connected world, and we've had a chance to think through a lot of the social, backlash and the challenges that have come with these two investment waves. All of this is going to be heightened in this third investment cycle. And so we really need to figure out ways to be transparent, be decentralized, bring the best data forward to solve, these very big issues.
Well, every once in a while, Josh, I have an urge to be blunt. And so I'm going to be blunt now. Tell me what you're thinking about China in terms of its real goals, sincerity in controlling emissions and so on? Is it because the Beijing government knows that if people can't breathe, there'll be a revolution? Is it because they think that the economy will perform better in the long term if they have better environmental conditions? Or is it that they actually give a damn about the rest of the world and whether they're creating too many externalities that make people choke from Japan to Seattle to India on their fumes?
Yeah. So again, very big questions and very important questions. And first off, again, this is the point of the podcast. I'm probably not the most qualified to speak on these, but I guess again, my point is, of the podcast is I believe that's an excellent mini series to go on, and we will tackle that question specifically. I mean, as Abaxx Technologies, as the sponsor of the podcast, two of the largest investors are probably one of the biggest China bulls and one of the biggest China bears. So we do have a very wide range of views. My personal view, I did have the opportunity back in 2007 to have dinner with the CEO of the Chinese State Grid, which is probably one of the largest employers in the world, probably one of the largest pieces of infrastructure, one of the largest set of customers in the world. And it was really a fascinating conversation. And we really had the conversation about, is there enough copper? What is the path of renewables? And that's going on 14 years ago. And I don't believe these same types of conversations have been had to the extent that they were thinking about that 14, 20 years ago. I had a similar conversation in 2010 with the UK Minister of Energy and Environment and started talking about copper mining, and they had no idea what I was talking about. I think there is, in the culture and the planning, there is this type of thinking. But that all said, particularly over the last 5 years, it was not only the environment, but it was also non-performing loans. You saw a lot of, central Chinese government mandates to try to rein in some of the, very heavy commodity infrastructure investments of the regions. And they weren't always that successful. Now, directionally, I think they were successful, and they were trying to solve both the non-performing loan issues of really overutilization of resource capacity, as well as the environmental issues. So again, I think this is it's a very complex question, and for a third of the world's emissions. But I do believe it's very sincere that they're trying to upgrade their quality of GDP growth as well.
Now, from the bottoms-up investor point of view, environmental, social, corporate governance, ESG has obviously become enormously interesting and popular as an investment style, having passed about $2 trillion in assets. I guess it's one of the fastest growing trends. What do you think is driving this, and where is it headed?
Yeah, so there's probably two or three pieces to that. One of it is purely a lot of papers recently on the ability of companies that score high on ESG to be, adapting to the global economy, managing risks better, particularly if you look at the governance side, and if we look at some of the environmental risks of having stranded assets on the balance sheet, and some of the social risks that we're seeing in a lot of social unrest globally, these are very big risks for companies. So not only has the investment style, really outperformed, and the companies outperformed, but also, they're seen as managing risks better. Now, that all said, just from a pure top-down sort of macro portfolio ESG perspective, it's still not certain that these companies have done well because they're ESG or because they're more heavily geared towards, the Microsofts and, Googles of the world, which obviously have, very high business margins, a lot of growth, and naturally a lot of adaptation in their business model. So, if you look at an ESG basket, versus S&P 500 basket, they're not all that different in many ways. And so that's one of the parts that's happening now. And I think we need to get better at beyond just, picking Silicon Valley, well-performing Silicon Valley companies to allocate capital to. Ultimately, we need the big upstream resource companies, as we're going through this energy transition. So we need to capitalize them not as dirty companies, but the companies that actually have the ability to do better and probably have the most impact from doing better.
Do you think that commodity markets can be recipients of ESG dollars? And how would you perceive that? I mean, I think about British Petroleum, which tried to rebrand itself Beyond Petroleum some years ago, and now I think more sincerely is taking action in that way. At the same time, you've got companies that seem very techy and very ESG friendly. And then, excuse the pun, if you look under the hood, you wonder whether buying an EV Tesla is really good for the environment through the life cycle. Like, what rare earths and precious metals have to be mined in order to create the lithium batteries and so on. So how do we get a more sophisticated view of ESG that goes beyond taking a Sharpie and crossing out Philip Morris or Exxon based on their behavior 20 or 50 years ago.
Absolutely. And that is, again, one of the central questions of this podcast is talking, and also giving a platform to the resource industry to really be transparent about, what they're really trying to do. So, before I answer the rest of that question, I should probably answer a bit of the last question as well. So beyond just the top-down sort of portfolio construction trends and in risk management, the other piece that I think is critically important is demographics and really the mindset of the millennial, buyer. And so I was, again, very fortunate that, just kind of when I grew up and went to university, I'm in that tweener generation between Gen X and millennial, where, my youth was fully analog and sort of pre-digital, but almost all of my, university and career has been fully digital. So I've been able to see a little bit of both, a pretty good window into both worlds. Even my older brother, really didn't even use email until he was in his 30s. And then my younger sister was sort of digitally native. And so I've been, very, very fortunate to be able to sort of straddle these two generations. And it's very clear that the more connected and more, globally connected digital generation is thinking, very much about sustainability. This isn't just a consumer trend that's driving change, but it's also becoming, particularly as millennials really take on more senior roles in the workplace, even internally in 2007, 2010, some of the first movers in the tech companies to really be focused, really on ESG, some of those sort of young, sort of change the world activists are now, senior managers and running, really driving change in their organization. And so I think that's incredibly important. And so, getting back to your question about, what the commodity industry, can do, again, first off, that change has also been happening within the commodity companies. And so that generational change. And, when I went to the Colorado School of Mines again in the late 90s, early 2000s, we had, bumper stickers like, Earth first, we'll mine other planets later, and there was this sort of pushback over environmentalism. But now, and I don't know the stats off the top of my head, but I would say there's probably more people going to the Colorado School of Mines, focused on really, climate science and being part of the solution than that kind of that attitude of, of sort of fighting the greens.
Josh, have you ever been to the Diggers and Dealers big meeting in Kalgoorlie, Australia?
So I actually haven't. So I guess being in Canadian capital markets, I'd spent a lot more time in like the PDAC, but I haven't been to that one.
Well, it's a fascinating place. And I gave a keynote lecture there some years ago. And it seems like it used to be the highlight of going to Kalgoorlie was to explore the old corrugated steel brothels that had been there since the early mining days. My understanding now is that now the bigger tourist attractions have to do with examining how to apply ESG to mining and materials and metals. But the question I have, is there anyone or any institution that is engaged in a kind of life cycle analysis of companies and products? I gave the example of Tesla and asking whether an EV car, when you take into account what goes into it and where the energy comes from the outlet into the vehicle, what the life cycle impact is environmentally. There are other examples. I mean, back in the 1980s or 90s, I think young parents were shamed if they used disposable diapers for their babies. They were told, you should use cloth diapers. And then after some time, some enterprising folks did a life cycle analysis of, if you use cloth diapers, then the diaper truck has to come by, pick up the diapers. Well, that uses gasoline. And then you bring them to some cleaning facility that then uses soap and uses water. So by the time you're done recycling cloth diapers, it's unclear that, in fact, it's better for the environment than the disposable sort made of plastic. So anyway, the question is there anyone or any institution that's looking at those sorts of analyses to give some guidance to ESG investors and give guidance to consumers who might also be interested?
Yes, for sure. And I guess that's the other part of the momentum that I've seen the last, particularly the last 6 months, accelerating significantly. because we do work with, the global energy industry and global LNG industry in, carbon neutral working groups. We're really trying to tackle those issues. But what I would say is most encouraging is not only the coordination and communication between the companies all working together to try to solve this, but also really thinking through what kind of market systems, and what kind of IT systems, whether it's, open source or open market, how do we actually bring the best information forward? And I've, as an engineer, I've done those sort of top-down studies, and I've tried to apply, a lot of, econometrics and, engineering first principles to try to design something from the top down and do those life cycle analysis. And they are very useful. But what's even more useful is if you price those externalities and let the market, coordinate better. So when I look at, what we're trying to do and, with SmarterMarkets, not only in the podcast, but what we're trying to do in our company, it's really not trying to, push a perfect solution, but create market structures to allow the market to bring the best solutions and price these externalities through the life cycle.
In some past episodes of Smarter Markets, some have talked about grading and trading various commodities based on their ESG specifications. There may be darker versions of copper and lighter versions, so to speak. I suppose in the world of oil, you have light sweet and sour crude and so on, different gradations and different prices. What are we supposed to think of that? Is there a viable way in which such distinctions can be made and capitalized on?
I believe so. And I think this is really where the market's headed. Again, because of the demand, both from, the consumers as well as, really executives in these supply chains. All of these heavy industries are really, really sharpening the pencil right now on trying to, account for emissions and sort of the ESG goals. Now, back to your question, one of the problems with the commodity, is by definition, it's a commodity. It's supposed to be fungible. It's supposed to be interchangeable with everything else. And this is a good and a bad thing for the upstream, resource industry. It's a good thing in that at the end of the day, these are companies that take a lot of price risk, to the top line that can be very volatile. And so by having a more fungible liquid market where you can, sell forward and hedge your production in an interchangeable market, that actually, provides a huge benefit for the commodity producers. So if you look at something like LNG, we're going to need something like $10 trillion in new LNG infrastructure to meet the growth projections. But right now, without long-term offtake agreements and without really a standard price to sell forward in the market, it's getting very difficult to capitalize these investments. So we really need that fungibility and standard price to allow capital to transfer properly. But on the same time, there's also going to be a very wide range of ESG scores that come along with what's otherwise a fungible commodity. It's really balancing that for the upstream producer, and that you can have better capitalization and better risk management if your product is sort of max fungible. But at the same time, if you are doing better, you should be paid for doing better. So this is the balance that we're always trying to find. So one of the things that we've been working on, again, with the global energy industry, is really thinking about, okay, so how do we sort of, break these into different pieces where the commodity can be most fungible, but you can also get paid most for the things that you're doing on a marketable, high ESG score product.
Josh, you had mentioned it, and others too, the issue of putting a price on carbon. And by carbon, we're not talking about, CO2 canisters for SodaStream. We're talking about something else. How do we create a price for carbon? What do people mean by that? And to what extent does federal governments have a role in determining a price on carbon?
So ultimately, I think governments are going to be very important and have been. If you look at the emissions trading schemes in Europe, for instance, and even before that, some of the other cap and trade systems that we've had in the U.S. This has been a very efficient market mechanism on a regional perspective to move the industry forward. However, the problem is, when you're talking about a global market, that global coordination is going to become more and more difficult. So, that's what's, given rise to a voluntary market. So if you look at companies like Microsoft and what they've been doing in the voluntary markets, to offset their emissions, they didn't sort of wait for, US-wide mandates. They just sort of got on with it. and started, doing their own accounting and setting their own internal prices and working towards that. So we've been very active again in that space as well, where you're going to have a lot of governments doing very, very different things. And so this is given rise to a voluntary market.
Josh, when you have conversations with your former colleagues at Goldman and elsewhere about these new kinds of markets that you're trying to develop and creating platforms for, what sort of reaction do you get? I mean, these days, there's so much news about FANG stocks, about social media, obviously about cryptocurrency and the like. Is it possible to get top talent involved in the commodity space in financial technology?
I believe that we can. I mean, first off, I guess, we're very proud of the team that we've put together at Abaxx. But again, it's around this, I think it's around the mission of what we're trying to do, both for the industry and for the markets, and in helping develop these critically important price signals. And I also probably want to touch on something that I guess as a sort of a serial entrepreneur that's really been jumping into some very big business ideas, very big markets. One of the other things that I find, I guess, challenging is that particularly over the past decade, we've seen, very high centralization in our financial industry. Whether we're looking at market infrastructure companies like exchanges or, of course, banks, central banks, so there's been a lot of consolidation, and a lot of that came out of the financial crisis, where combined with an IT cycle that, yes, there's a lot of efficiencies in centralizing a lot of data, but at the same time, it can kind of, stifle competition. And so really now we're at a point where, what should be some of our pillars of capital markets and competition are actually becoming, very oligopolistic. And I believe, in the sort of, creative destruction and entrepreneurs that can sort of have the diseconomies of scale to move into big problems. So yes, I think it starts with the mission, and it starts with the type of people you have. And I do believe that a lot of people want to work in fintechs and startups that are going after these very big challenges.
Well, and I think now is the time. If you can't get interest at a point where so many commodity prices are reaching all-time highs, or at least decade highs, this is the perfect storm. And you add to that, and I actually wanted to get your views on whether Federal Reserve Board policy will play a role in attracting interest from both from the point of view of building such platforms, but also investor interest. Jerome Powell at the Federal Reserve Board, former colleague of mine from the Treasury Department, seems he might as well be the spokesperson for modern monetary theory. He is rewriting monetary theory with, some people would call it reckless abandon. I suppose he thinks it's prudent based on the fact that the unemployment rate in the U.S. is still around 6%, and he still thinks there's vast amounts of excess resource and supply of labor on the sidelines that can be brought in if the economy is allowed to run hotter. At the same time, some people, legitimately, I think, are worried that the risks for inflation have gone up. Traditionally, we would think of gold as a good hedge against inflation. Now, of course, cryptocurrencies may be there, but then other commodities, metals, and the like. So what's your view of Federal Reserve Board policy and its possible impact on the markets that you follow so closely?
Well, this certainly is a challenging one. In many ways, it has been that sort of access to cheap credit that's allowed the economy to continue to grow. But I do believe there's something, unsustainable in it, and that we're sort of developing this economy where it's, the price signal is being lost in many ways, where sort of access to credit, becomes more important than profit, particularly at the smaller scale, sort of entrepreneurial, challenging companies. And so that to me is problematic. As the bigger you get, the easier you get, access to cheap credit. We sort of stifle competition in that way. So that's one issue. And of course, you also mentioned the inflation. We have these very, very big issues that, that we should be allocating capital towards. But at the same time, you see something like, Dogecoin, going to a, $50 billion market cap, right? So the misallocation of capital, I think, is very problematic given what we actually need to try to achieve. And we need to be very efficient with that capital, with those time and resources. And so again, like in my mind, that doesn't mean let's go to a heavy top-down central planning. Like, I actually think it's being more decentralized and allowing more competition that's going to get there, rather than relying on more and more centralized central bank policies.
Josh, a few minutes ago, you helped us define commodities as fungible. A bucket of sand should be equivalent to a bucket of sand, and so on. One of the hottest buzzwords these days is NFTs, non-fungible tokens. And of course, we see Jack Dorsey at Twitter sold his first tweet for some ungodly amount of money. I don't know whether he gave a little bit of that to Donald Trump, who probably helped keep Twitter alive over the last 4 years. But anyway, is there a world in which commodity producers might be selling products as NFTs from a technology perspective? How would that work?
I do believe so. Absolutely. I mean, ultimately what the NFT is it's a type of smart contract. It's sort of furthering the path of digitization. And so when I talk about a fungible commodity, just if you look at it as an example in the sort of the copper supply chain. So again, that sort of LME copper is meant to be the most fungible form of copper, and it trades a very efficient system traded on the LME or the Shanghai Futures Exchange. But at the same time, that intermediate product, the crude copper product before you get to the LME, a copper concentrate, isn't so fungible, right? It's going to have all sorts of different quality blends, locations. It's big and bulky, and so at the end of the day, that copper concentrate is not as fungible as that copper cathode, and that's just talking about technical specs. Again, now you add environmental specs, and you're going to see another wide range of marketability of a crude commodity product. And so ultimately, I think what is going to happen is that we are going to design sort of NFT structures that more and more information can be captured at the earliest stages of the resource project. And I would say, even before the copper concentrate, you look at actually, copper metal in the ground. I believe there's a system in the future where we can track and trace that resource, not only in, new exploration models of geology through NFTs, sort of pre-selling, a royalty or a right on the copper in the ground, and then that right tracking all the way through the supply chain. So we know, the ESG scores, we know the quality. So I think that smart contract mechanism is going to be very important in the future.
How important or how valuable can blockchain be in these sorts of things? And when I say important, I had a conversation with the CEO of one of the major railroads, and we were talking about blockchain. And of course, we've all read and heard about how it could be valuable because the next time there is a, mad cow breakout, if we had adapted to blockchain, we could more easily identify the source. And we hear about blockchain can be used for the provenance of artwork and so on. What is the market failure today that creates the opportunity for blockchain in commodities? What's not right that needs to be repaired, or where there is a huge opportunity?
Well, I think it's a huge opportunity because what it is, and I try to break it down, beyond just the sort of the buzzword of blockchain, what is it specifically? What are the aspects of it that are going to sort of revolutionize the way we trade? And for me, it's two pieces. It's digital identity, self-sovereign identity, and then it's the actual open permissionless data store, an actual database that's encrypted and secured, but everybody's, accessing the same information. And so, there's a lot of efficiencies in bringing these like highly centralized data systems together. And so, what we have today is, again, sort of trending towards these larger oligopolies that have access to the most data, but they're still not necessarily interchangeable with each other. To solve the coordination problems that we need to solve to meet these very big goals over the next 10, 20 years, we can't just assume that everyone's going to centralize their databases into one cloud platform with the best AI, right? We're not just going to move the entire world onto AWS and have all the perfect data, running through that system. At the end of the day, whether it's for regulatory reasons, competition, there's going to be data structures everywhere. And so what we want to do is design the protocol layer, not necessarily where the application is. We want to design a protocol that allows everybody, the right incentives to bring their data to market while still keeping it secure for reasons that they may need, whether it's for bargaining reasons or for regulatory reasons. We need an encrypted and secure data where we're not just centralizing it all in the hands of one player, be it a government or a very large tech company. And so what the blockchain does specifically that allows us to solve that coordination problem is this sort of decentralized data store tied to a very strong identity internet. And so this is a system that we've been investing in significantly because we think it has an ability to solve problems, these market coordination problems globally.
Well, now, Josh, as long as we have you on the air today, one of the world's foremost experts in metals and mining, I wanted to ask you about what goes into EVs and battery technology, because we see copper prices, palladium prices, lithium, and so on, being driven by housing demand as well as EV demand. There's so much copper in cars and homes these days. Well, let me put it this way. Are you seeing some new potential replacements for the lithium batteries that power EVs? And if you do, will they be using different kinds of rare earths and metals than the sort that go into production today?
This is a problem. Again, better pricing is going to help us solve a lot of these issues. But yeah, a lot of these metals will end up, we'll constantly engineering and re-engineering, based on the volatility of different commodity prices. You look at it, even a product like cobalt, it probably would have been used a lot more than it is today, even before this EV revolution, if it wasn't so volatile and only have sort of a small source of supply sort of 15, 20 years ago. This is where we're trying to create commodity markets that are more fungible so that we can have a better forward-looking view to make the right investments in the right metals is very important. Again, ultimately, I don't believe there's a shortage of any of these metals, be it base metals or precious metals. And in fact, if you look geologically, what you typically have in most of these metals is a very flat supply curve, just from a first principles perspective. The types of, mineralization, the fundamental cost structure of different types of mineralization. So yeah, there's always going to be a very low on the cost curve because it's got, very high grades or has many different polymetallic revenue inputs. So those things never set the price. Those things are going to be profitable in really any scenario. But if you look across, most geologic curves, they're actually very flat on a global scale. So ultimately what it comes down to is it's politics. And these are very large developments. So when it takes, 10, 15 years to get a mining project off the ground, there's a lot of risks up front that you need to be aware of. So having the best price signals and being able to capitalize those projects early is very important. So there's never a shortage of minerals below the ground. It's usually the political and economics above the ground that becomes the problem.
That brings up an interesting point because, when I was a kid, I loved maps, and I'd look at maps, the atlas of the world, and there was still a Soviet Union then. And some of the pages of the atlas would show you the natural resources. And the U.S., of course, was rich in wheat and other sorts of things. And the Soviet Union with Ukraine was rich in wheat. But the Soviets seemed to have so many metals, and including bauxite. I had no idea what bauxite was when I was 7 years old, but I was concerned that, it was like going to be the kryptonite if there ever was a battle between the U.S. and the Soviet Union. Thankfully, there was not a battle between the U.S. and the Soviet Union. If you Google where are rare earths or rare metals today, you'll come up with a chart that shows China at the top. My question, is it that China has vastly more than other countries, including the U.S., under the surface? Or is it that they've tapped into it and created the reserves because they might have different environmental standards? Because quite often you hear some people say, well, if we become too EV-oriented, for instance, we will become too beholden to the Chinese, as if that's the only place that you can get some of these rare metals. So set us straight. Is that correct or is it wrong? How do we look at this?
Yeah, so it really is the integrated supply chain that matters. It's not always just the resource. Again, some minerals, will have a natural resource sort of strategic advantages. You talk about Russia, in the nickel complex in Norilsk. This is a geologic anomaly that feeds a lot of the world's nickel and palladium. We have these sort of geologic anomalies in many different commodities. But again, that doesn't really set the marginal cost. That's really just sort of the base supply of a lot of these minerals. But really the challenge in supply chains going forward in this great electrification of the global economy, towards more renewables, getting off of that 80% of hydrocarbons and moving that more towards electrification, it's going to be so metal intensive. And one of the big problems is not actually the upstream part. It's really the smelters and refiners. And that's really a place that China has really dominated over the last 20 years. So even if we did want to mine more rare earth deposits, we don't have the processing and the midstream production. And I would say a lot of that has to do with environmental policies. People just don't want those types of processing in their backyard. And that's been an issue. And so if I look at, specifically what's happening in China, particularly, going back to their 2060 decarbonization goals, I actually believe that China will stop being a net exporter of things like steel and some of the more intermediate commodities that we've relied on over the last 20 years because of some of these goals, because they want to upgrade their environment. So if we've now got, some industries, 60, 70% consolidation or more of that midstream production, smelting and refining, happening in China, and then they switch to not wanting to be an exporter anymore, this is going to become very problematic for a lot of the EV goals of many other countries. And so, this I do believe is a big issue, is that we just have not been building many smelters and refiners in our backyard the last 20 years.
Josh, earlier you had mentioned the bumper sticker at the Colorado School of Mining, mine the earth first and other planets later. This question of decarbonization also brings up the question of how much land it takes to put up enough solar panels and enough windmills. I saw a chart recently that showed that per kilowatt hour, it might be 30 times as much land needed for solar as for a more conventional plant. Do you think that's going to become an important issue, or do you think we've got enough sunny fields and unoccupied places in the States that it will not be a major obstacle to decarbonization?
I think it will be a big obstacle because of the politics of land. And I would also add water in there. Most of these resources, it's not really a question of absolute scarcity. A lot of times it comes down to land and water. Those are the biggest pieces of the politics. Again, if we're trying to project, what we have today and try to scale it, moving from, again, 80% hydrocarbon and in a much smaller piece in renewables to try to flip that around, what happened, even over the last few years, which have been incredible in bringing down the costs of solar and wind, projecting that whole thing at scale, I don't think is, yet achievable. And land and water and metals and smelting is going to be a big part of that.
We hope you enjoyed this week's episode of Smarter Markets featuring Josh Crumb, founder and CEO of Abaxx. Next Saturday, I will hand the microphone back to my co-host, Michelle Dennedy, as she explores the role of digital innovation in advancing the ESG economy over the course of a 5-part mini-series. Michelle's first guest of the series is Gajan Kandaya, CEO of Hitachi Vantara. Gajan leads Hitachi Vantara's 11,000 employees with a focus on leveraging the company's digital infrastructure, software, and services to meet the business and cultural transformational needs of his clients and help them contribute to the advancement of a more inclusive and sustainable future. Listeners, please help us get the word out about Smarter Markets. Your ratings and reviews on Spotify, Apple Podcasts, and other podcast platforms mean the world to us, as does your help spreading the word about Smarter Markets via social media and word of mouth. On behalf of Abaxx Technologies, I'm Todd Buchholz. I look forward to joining you again on Saturday, June 26th, after the conclusion of Michelle's much-anticipated 5-part series.
That concludes this week's episode of Smarter Markets. For free episode transcripts, visit smartermarketspod.com. Smarter Markets is 100% listener-driven, So please help more people discover the podcast by leaving a review on Apple Podcast or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Smarter Markets, its producers, sponsors, and hosts, Eric Townsend and Abaxx Technologies, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Smarter Markets.